Hello and welcome to this valuation under IBC. Uh, Prior to this IBC, the insolvency and bankruptcy laws in India, they were multi-layered and fragmented layers, and that recovery has always been an area of concern for the financial sector. Several methods and processes were adopted prior to 2016, but conceptually it revolved around the recovery alone. Initially, the government had framed the SARFAESI Act 2002, which aimed to recover the NPAs of the banks and financial institutions. The Act aims to shut down the unit or company and very rarely work towards the refabricating it. Wiped out Sikh Industrial Companies Act 1985 and the twisting up arrangements of the Companies Act 1956 have not succeeded in recovery of the financial sectors. Keeping in mind the strain of the market society and to improve the business environment and alleviating distressed credit market, the government introduced the Insolvency and Bankruptcy Act Bill in 2015. In India, before IBC, the lawful and institutional apparatus for managing obligation default has not been in accordance with the worldwide norms. For example, the Presidency Towns Insolvency Act 1909, the Provincial Insolvency Act 1920, Sikh Industrial Companies Special Provisions Act 1985, Recovery of Debts Due to Banks and Financial Institutions Act 1993, and so on. For the first time, the Modi government thought differently with an attitude shift towards the resolution. Rather than recovery and ease of exit was created with the introduction of Insolvency and Bankruptcy Code 2016. It came in simultaneously the Insolvency and Bankruptcy Board of India, IBBA, came into existence because there was deemed lack of a properly structured organization to take care of falling companies and their liquidation. IBC 2016 is a unique compendium of laws framed for fast-track resolution or liquidation to release the huge capital that is locked up in companies. The primary objectives of the following are the primary objectives to be achieved by the Insolvency and Bankruptcy Code 2016 was the resolution and liquidation in a time-bound manner, maximization of value of assets of corporate persons under insolvency, to promote entrepreneurship, availability of credit, and balance of interest of all stakeholders. With this, out of these 5 objectives, 4 objectives directly deal with the valuation and 1 objective deals indirectly with the valuation. So it becomes very important the valuation has to be in line with the purpose. Accordingly, CIRP and valuation liquidation processes which depend upon valuation only, and significant number of resolutions and liquidation of stressed assets under the IBC proceedings has resulted in the revival of productivity in the form of CIRP and liquidation by channeling the financial resources recovered under the IBC process into the mainstream economy, both of which otherwise could have led to significant wasting. CIRP and liquidation processes are dependent on not only an appropriate valuation for a defined purpose, but also should stand the test of legal scrutiny in case any of the stakeholders, including committee of creditors, insolvency professionals, financial creditors, operational creditors, and such others, are directly or indirectly affected by the valuations, dispute the same in any or all adjudication proceedings under the IBC 2016. Hence, the value conclusion by the registered valuer has to be robust and appropriately established during the IBC proceedings. Evolution of valuation profession has been very static, and the journey of this can be seen from first act in 1894, that is Land Acquisition Act of 1894, till recently the section 247 of the Companies Act 2030, Company Valuation Rules 2017 and IBC 2016. The valuation process has undergone a transformational from a mere estimation of the determination of the market value of the to the asset being valued. The role and significance of valuation of assets of different kinds, both in the regulatory and non-regulatory spheres, have made the value conclusions arrived by the valuers very crucial for the stakeholders. Valuation of assets required under the SURFACI Act, that is under Income Tax Act and the SEBI Act 1992, etc., and the large volume of mortgage valuations for banks and financial institutions are considered to be the backbone of the stability of the economic and financial markets of the country, as well as the stakeholders, including the end users. With effect from 1st February 2019, every valuation required under the Insolvency and Bankruptcy Code 2016 or any of the regulations made thereunder is required to be conducted by a registered valuer, registered for the respective asset classes, that is a valuer registered with the IBBI under the said rules. The end users of the valuation services are demanding more robust valuations to meet their objectives. Who are valuers? The question arises now. And with the recognition of the concept of registered valuers under the Companies Act 2013 read with the IBC 2016, a valuer, it is important to note the difference between the term valuer and registered valuer. As per the international valuation standards effective from 31st January, a valuer is an individual, group of individual or individual within an entity regardless of whether employed or engaged, possessing the necessary qualifications, ability and experience to execute a valuation in an objective, unbiased, ethical and competent manner. In some jurisdictions, it is required before one can act as a valuer. Registered valuer means a person registered with the authority as a valuer in accordance with the provisions of the Companies Registered Valuers 2017, and one has to comply with the following compliances such as Companies Act 2013 and provisions of the IBC 2016, Code of Conduct of the concerned registered valuer organization, bylaws and internal regulations of the registered valuer organization of which he is a member, and compliance of valuation standards, that is internationally accepted valuation standards, compliance of guidelines time to time issued by the authority, and compliance under the other different laws like SEBI, Income Tax Act and other such matter. There are three categories of asset classes to be for the valuers, that is land and building, which depends on the sort of building, its structure, durability, location, size, and etc. And plant and machinery, securities of that is the plant and machinery which helps in running the day-to-day business of the organization. And the securities or financial assets. Securities are tradable and financial instruments used to raise capital in public and private markets. And there are primarily three types of securities: equity, which provides ownership rights to holders; debt, essentially loans repaid with periodic payments; and hybrids, which combine both the debt and the equity. The qualifications required accordingly depend upon the category of assets. The valuation and issuance of valuation is basically in a structured manner as far as the standards are concerned, and even the company's rules 2017 say so. That is, the scope and purpose of valuation shall be defined into the registered valuer. Basis of valuation: selection of appropriate valuation standards, selection of appropriate approach, that is market approach, income approach, or cost approach, nature and source of information used by the registered valuers while conducting inspection and valuation, and premise of valuation, highest and best use, orderly, all those things, and departures and deviations occur during the material differences. These are organized in the frontline regulators. Those are called registered valuer organizations, which help in regulating the valuers, registered valuers, and to ensure the aims and principles of ethical standards such as integrity, objectivity, truthfulness, and so on, and conduct educational programs for their upliftment and for the entry level 50 hours educational course, and subsequent examinations are taken by Insolvency and Bankruptcy Board of India, and the syllabus is according to what is determined by the authorities, and then conduct a training for issuance of certificate of practice, and monitor the activities of valuer members, its valuer members, after they become registered valuer and come into the practice, and seek their the redressal of grievances against them, and accordingly disciplinary actions. By creating awareness amongst the registered valuers for their responsibilities and accountability for the specific assignments being carried by them through various interactive sessions and continuing education programs, and by scrutinizing the valuation reports of the registered valuers and pay random visits while inspecting the registered valuers to understand and improve the procedures being followed by them for carrying out the valuation assignments as registered valuers, and by creating awareness on modalities of getting the valuation assignments through CEPs, that is continuing education programs. Under IBC valuation, it is the requirement is of fair value and liquidation value. As per IVS, fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transactions between market participants at the measurement date in an assumed transaction. Fair value is computation of an asset value based on an orderly transaction, assuming sufficient time to market and due diligence by an hypothetical buyer. If a fair value of an asset is based on existing use, the assumption must be stated in the report. Similarly, if the asset is being valued for a purpose on a standalone basis and held for sale, then the fair value based on its highest and best use need to be ascertain. If what critically defines value is the basis of value adopted by for any given valuation, all other things being equal, an asset could be considered on a number of bases of value as at the same valuation date. For example, replacement costs and market value, investment value or forced liquidation value, etc. Whilst all of these values outcomes, they would each yield different valuation results. Moreover, it is critical that valuers analyze the plethora of information available in the market to ensure that it is considerable and appropriately having context to the basis of value which being considered as part of the valuation. So fair value and requirement asks of a valuer to educate and upskill its members to respond for challenging technologies and evolving market needs. It's the need of appropriateness, transparency, and consistency in valuation of assets is felt more than ever before by the stakeholders. The valuation practitioners of different classes of assets must gear up to meet the professional demands of the fast transformation happening around. They can achieve these by upscaling their professional skills, competency, simultaneously meeting the regulatory obligations as we move towards the full-fledged and comprehensive regulations in the market. Before concluding, it is required that important pillars to ensure the role of self-regulatory system in which is very important in any profession. These are 3 R's. That is redressal, review, and reforms. So evaluation is such kind of a profession where valuer's opinion becomes a key input during a transaction taking place of any kind involving varied clientele of stakeholders. All such opinions may have to go through the crucibles of adjudication. At the stage, there is a scope of redressal of these grievances by making necessary rectifications and justifications for the services provided. The process may lead to avoidable conditions of the deteriorated to get further deteriorated. Institutional interventions in such instances may provide proper guidance to the valuer, which may be not only in the form of grievance being redressed, but also to provide directions and advices for the valuers. Reviews is another area in the same manner, where the valuation assignments being undertaken by the registered valuers. This is a preemptive approach for any later day inconvenience and undesirable conditions. Getting the review may be desired either due to the grievances from stakeholders or for the self-assessment purposes. Reviews done for the purpose of self-assessment is termed as peer review and is beneficial for early rectification and improvements in the works done by the valuers. And lastly, and not least, is the reforms, which is the base for the upliftment or upskilling of a valuer, where through knowledge of his redressal of grievances and the reviews, the path to be taken for the reforms in one's work can follow. And before concluding, I would like to highlight that as valuation has been defined as a craft, we should remember that assessment is the first and most critical tool in crafting valuation. Apart from being qualified, a valuer is required to develop the skill in crafting a valuation opinion. And in order to establish the exclusive demand for a profession, strong foundation of academic pursuit coupled with self-regulation are required to be in place. Therefore, to meet the academic requirements and all these requirements, professional education development program plays an important role. The way forward to this, the profession, can be had by moving towards the act, that is Valuers Act, which is there, and the profession of valuation shall occupy a unique position in the economic and financial spheres. Here I would like to mention that the valuation profession has to go a long way, and the need of the hour is for the entry of the younger generation, and at the school level and even at the graduation level, there is a need to provide the information regarding this profession, which still is missing. And the idea is to create an awareness about such a profession which is of such an prominence or importance, where even the honorable judges in number of cases have pronounced that the judicious opinion of a valuer is vital in resolving such cases. So our message is very clear that it is now our as valuers, our fraternity's turn to move ahead to become such important professionals where we are sought after and looked after to give robust valuation opinions and move towards and work for the benefit of the country as a whole, for the economy, because it is the backbone of the economy. If we talk of $5 trillion economy in coming years, it is the valuers who have to produce or who have to take part in resolving such financial transactions where their inputs are become very vital and important in such cases. Here, the difference between a registered valuer and a valuer the gap has to be reduced, and more structured in a structured manner. If valuation and the valuers move forward, this profession is going to take a very, very vital position. Thank you and goodbye.